Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with William Horlick of Elder Street Investments to talk about the Draper Esprit VCT. First off, Will, tell me about the Draper Esprit VCT. What does it aim to do? What's its background?
It was founded in 1998 as a generalist VCT. And in 2016, we did a deal with Draper Esprit PLC, who are an AIM-listed venture capitalist. They have a market cap of over 500 million. And we co-invest alongside that PLC balance sheet money and their EIS funds. Since we did that deal, the syndication arrangement with Draper, we have invested in 15 new deals with them.
So tell me about your own background. Have you been at Elder Street since the beginning?
I've been at Elder Street since 1998. Previous to that, I did some investment banking, but more importantly, I ran a business. So like you running your business, we know and understand the models, cash flows, etc. So within the wider team at Draper Esprit, there are 17 investment professionals. The wider team is about 30. There's a huge amount of experience within that team, from 3i through to entrepreneurs, doctors, all sorts of skill sets.
What sort of companies will I be investing in?
Well, it'll be tech focused, but we have four sectors really. But let me give you a flavour of some of these businesses. So in the enterprise space, for example, we have a business called Roomex. It is a business-to-business workforce travel management platform. It has over 40 million of gross bookings going through that platform. It's growing quite quickly. So if you think of a bookings.com for consumers, this is down at the SME level. All of those players need to have sort of their corporate travel organised for them. That's one. Another one is Endomag, which is a healthcare medtech business. It has hardware. It's in the cancer detection and pinpointing where the cancers are. That is growing very quickly. It has international scope through its resellers. I think last year when I was here, I'd said that the Draper Esprit EIS had invested in a unicorn called GraphCore, which was a advanced chip designer. We have a business in the VCT which has all the attributes of being a very, very valuable company. It's a business, it's called Evonetix, and it's in the DNA synthesis area. So the reason we invested in it is because of the management. The CTO had been part of the team that broke the human genome. That was commercialized and turned into a business called Solexa. That was eventually sold for 600 million pounds to an American outfit called Illumina. That has gone on to be worth many, many billions. So the management have come back and we have backed them to effectively build the technology on chipsets to build long strands of DNA. Highly complex, but very, very good management, very, very good tech.
So where do you get these deals from?
Well, that one came from Cambridge, where Draper Esprit have got a very good reach. A number of their executives and partners are part of the Cambridge network, so we have very, very good deal flow.
Do you find there's a lot of competition for these deals?
There's always competition. It's a pretty competitive space at the moment. If I was to say who are immediate competitors for the joint Draper Esprit, our VCT and EIS, we wouldn't traditionally look at the other VCT players out there. We would think of the Indexes, Atomicos, Baldertons. So the institutional venture players who, if you're an individual retail investor, you probably would have no chance of getting into those funds via our VCT. You do have the chance to get into that deal flow at that level.
There's a lot of talk about very high valuations. Are you finding that?
Yes, it is competitive. We have turned down some deals this year over the summer because the pricing, we felt we couldn't pay the prices that some of the other investors wanted to pay. Particularly, there were two businesses we liked, and they went to US VCs. We do have to maintain some price discipline in this. While we can use instruments, financial instruments to benefit our shareholders in the deal, price is key.
Am I right in saying that most of the companies you're investing in, they're quite a long way off profit? So is there and they require an awful lot of cash. So is there a danger that if everything stops for a while, maybe the economy isn't quite so good, that these companies could run into trouble?
Is that a reference to WeWork, if I'm allowed to say that? Yes, well, the businesses we're backing for growth. So we really aren't interested in making profits on a short-term basis. So we want to make sure that the capital or the cash that's generated in the business goes back into growing the business itself. Underlying, though, they must have a feasible business model so that at the end of the day, when you sell that business to a trade buyer, that there is actually a real business within it.
So let's talk about the older part of your VCT portfolio, the traditional VCT investments. Tell me about those.
If I give you an overview of what's in the VCT today, just over a third are Draper Esprit tech investments. About the same amount, a third, are what I call the legacy investments, and just under a third is in cash. So on the legacy side, 94% of the value of that legacy portfolio is made up of 4 companies. 2 of them are AIM quoted, 2 of them are private businesses where we own, or the VCT own, just under half of those. They are going quite nicely. There's an element of technology to 2 of those businesses. One is a software business, that's the AIM one, with 12 million of recurring revenue now. And the other is a tech-enabled manufacturing business, which has just posted its highest turnover and best EBITDA for the year. Unfortunately, they have all repaid our debt, so we have no income from our loan notes, but they do pay us a rather nice dividend every year. So those are fine. For new investors coming in now, I would say that by the time they qualify, there will be very little of that legacy portfolio in the pot.
So does that mean that dividends are going to go down?
No, we have over 25 million of distributable reserves. We will pay the dividend, which we target 3p, which comes out to just over 5% on a flat yield, just over 7% with the tax breaks. We have the reserves to pay that for the next 7 years, all things being equal.
And I assume there's a wish really to keep those older companies, although there's only 4 which make up most of the portfolio. You'll want to keep them as long as you can.
When the time is right, we will sell them. There's one we can't sell because, as you know, VCTs cannot have control. So we will wait for that to run through its normal course of action. I would say the 2 others, 2 of the others are growing quite nicely. And when the time comes, we aren't wedded to keeping them particularly, but they would probably have to see quite a nice offer from the trade to sell them.
And have you had any recent exits?
We haven't. We haven't had an exit actually for 2 years, where we sold down one of our AIM companies. We took out cost and the same amount again as profit, and we're running the rest. So we haven't. But I think there is some promise within some of these early Draper companies, and I think within 12 months, I think we will see some interest for some of those businesses.
So the VCT today is sort of very different from the VCT 3 or 4 years ago. How risky is it, would you say?
Well, there's risk associated with everything. If I was to say out of 10 companies, if I look at what Draper Esprit plc and the EIS have achieved since their IPO in 2016, out of all those exits, there's only one which has returned nothing. There will be some businesses which we don't follow on and that do recoup no funds for us. However, we do have that big alpha possibility where we can get a 7 to 10x on some of these.
So Will, if someone wants to put money into a VCT this year, why should they go with Draper Esprit?
the strategy of investing alongside these other funds, Draper Esprit and the PLC and the EIS, really I think makes a difference to us. We're doing very large deals of £10 million a go across those three vehicles. And I think that makes us very different to a lot of VCTs out there. If you ally that with the dividend that all VCTs are paying and the certainty of getting that because of the distributable reserves, then I think we've got a very interesting play here in our VCT.
William Horlick, Draper Esprit VCT, thank you very much.
Thank you, Alex.